Welcome to this video. We're going to discuss now chapter 29, the monetary system. Remember, this is a book of Gregory Mankiw, Principles of Economics. So first, we need to think now more about the real life. So when we think about any transaction that we perform, usually debit card, cash, or check. Check, we would say, like less used than before, more now debit card or cash. The money per se is worthless. I mean, if you take into account the value of the just one bill, it doesn't value the real value that the other person receive. But actually, the thing that makes this money that it worth is trust. Why? Since everybody accept it easily, depending naturally the country you are. Because if you are in, for example, in United States and you want to pay in Mexican pesos, maybe it's not going to be so easy. But if you are paying in the money of that country, naturally this should be generally accepted. This transaction, when you pay, for example, in a restaurant and they receive this money and then make the payments to suppliers, and then suppliers take this money to pay salaries, and then with these salaries they go and make shopping. This transaction is repeated over and over. So then this money is accepted, and because it represents goods or services in the future, and everybody is delighted to accomplish your desire, your wishes for goods and services, because you are aware that this money can be used in future transactions. The situation that we had before the monetary system existed is the situation, for example, that you can offer some product or service. So instead of paying with money, you offer that you will become maybe a waiter or a waitress. Definitely this should be like kind of hard, because we need to expect double coincidence of ones. The thing that I wanted from you is exactly the same that the other people, or the other person, the other part wants from me, which is definitely so difficult, and to compare, to establish, so definitely so hard. Well, the idea with money is like everybody specializes in the thing we are better, and we, as a consequence, we make a standard of living higher. So what is first the meaning of money? Because I know that everybody knows about money, but maybe in economics terms, it's a little bit different. Because, for example, we said, Jeff Bezos has a lot of money, we say, but actually we are thinking more associated with wealth. But the money is the set of assets in the economy that people regularly use to buy goods and services from each other. So then it's one part of our assets, but it's not considered all of the assets. It's just one specific part. For example, when we talk about bills in your wallet, for example, this is money. However, stocks, they're assets, they represent value naturally. However, they are not money, because stocks, you cannot pay to a restaurant, you cannot pay your subway, your transportation with stocks. First, you need to convert these papers into money. Then these will potentially become money, but they are not money. So money is a term that just we for a way of exchange. Now we need to think about the functions of money. So those are the three characteristics of money. If these fulfill these three features, we are talking about money. First, this should be a medium of exchange. Second, unit of account. a third store value. So what is the meaning of medium of exchange? So it's an item that can be given to sellers when they purchase goods and services. So this could be make different transactions from one part to another one instead of receiving any good or service. Unit of account. So so not good or services. We don't say, for example, a meal costs 1/10 of a shirt, or a loan or a record. Actually, loan or records, they are measured in dollars or in the currency that we are talking in your specific country, in rupees or maybe in Colombian pesos, in euros, and in any other currency. But the other one, the unit of account, maybe the good or services, they are not really good to provide this service, and all the transaction, yeah, they are definitely easier. And the third characteristic is store value, because you can, for example, the money that I have now in my wallet, I know that they are going to like buy other goods and services tomorrow and the day after tomorrow, and so on and so forth. Naturally, I know that this is going to be with maybe the purchase or acquisition. This is going to change a little bit, but in short run, the change is not going to be like so hard. So then, this is another characteristic of money. So an important definition here is liquidity. Illiquidity is a really common description of money, because this is the possibility to convert an asset into money. And naturally, by definition, money is the most liquid asset. If you keep money in your wallet, it tends to buy less good. The relationship, then this is the key point, how this should be, this relationship, how it affects the economy. Then we have another characteristic of money, which is not now, this is not used anymore, but before, commodity money, it has intrinsic value. Bill support by money, it is a system under gold standard. In the beginning of 20th century, the bills, they have the possibility that you can go to the bank and you can ask for this quantity of gold represented in this bill. This was like a support of gold. So this is what we call under gold standard. But now the currencies, they don't work like that anymore. Actually, another interesting characteristic of money that we had before, it was in 1980s in Soviet Union, where the cigarettes were the money in that time, because at this particular time the ruble, it wasn't like really accepted, so it was like losing a lot of purchase acquisition during the time. So for this reason, cigarettes, they were a good option. So even if you're not a smoker, you can ask for cigarettes as a way of payment, because you know that you can go with those cigarettes and pay for other goods and services. Now, what we know more and what we are used to is like money, it doesn't have intrinsic value. So, for example, the bills printed by US government are recognized as money, but per se, you cannot do anything with that bill. This is just like a way of exchange. And what about the money in the economy? So, the money is the quantity of money. The quantity of money is circulated in economy is what we call, or what we say, the money stock. And the currency is the paper bill and coins in the hand of people. Then we have the other side, which is demand deposits. This is like money, just instead of having in currency, you have in your bank. So this is convenient as currency to pay goods and services. We compare currency or demand deposits. They're exactly the same in terms of liquidity, because with both you can buy goods and services. And then the mutual funds, maybe you can dispose of them to make transactions. If you can call however, I mean, whatever you want. Just if you can dispose for that money immediately, it means that it is money. So here is the situation of M1. What is the M1? M1 we say like is the money stock in the United States. So we have currency, demand deposits, traveler checks, and other checkable deposits because all are like the most liquidity assets. However, we have here we can add here saving deposits, small time deposit, money market, mutual funds, and few minor categories. All of them you can convert in money easily. So then we can label that in the category of money as well. So when we talk about money, we talk about M1 plus M2. Then it's difficult to make difference between what is money and what is not. This is not easy to grasp. However, we know that, for example, before going to this situation of the credit cards, we know that stocks, they are not part of money. And bills, yes. So the extremes, they are clear. Maybe some like middle points that they are kind of hard to understand if they are money or not. Here, the credit cards, they are not part of money because there is more a method of deferring payment. Usually, we pay a lot with credit cards. Per se, this is not money. But once you use your debit card to pay your credit card, this transaction, this is now money. Now, because you are now paying this deferred payment, this already being paid. Then we need to start to understand now that we know the definition of the money, the use of money, the features of money. We are going to start talking about who controls money in any country. In any country is controlled by the federal or the central bank. In United States is the Federal Reserve System. This is actually when we have like a fiat money, but actually we know that this is like it doesn't have like intrinsic value. This is more of trust, and some entity has to regulate the system, and this is the Federal Reserve. When we call about the Federal Reserve, when you will see in the newspaper is FED. It stands for Federal Reserve System, which is the central bank. It basically regulates the quantity of money in the economy. It was created in 1913 after major crisis with different banks when at the end of the day the country thought that it was the best form to manage the situation of money in the country. And actually all of the other countries, they followed that situation and they have central banks that they regulate the quantity of money in an economy. This is run by Board of Governors. This is composed by 7 members appointed by a president and one confirmed by Senate. The governors, they have 14 years. It's a long period because this is basically to ensure independence from politics to make monetary policy. Because as we know, as we reviewed before about the invisible hand, for example, the less intervention in economy from government, the better. So then this Federal Reserve System followed that pattern, and they try to make the most independence possible because they take away all the opinions from the politics and they try to focus on the situation of monetary policy and on best technical solution for economics issues. Among the Board of Governors, the most important is the chair. At this time of the video is Jerome Powell. And then the others, they are 12 regional Federal Reserve banks. They are located in major cities. And the first objective is, first should be regulate banks and ensure the health of banking system. So verify how is the liquidity of the banks, how is the behavior in terms of loans, in terms of deposits. So at the end is the bank's bank, like the banks is the father. So when the banks want to borrow, Fed provides liquidity, so it's considered a lender of last resource. A second objective, and actually is the most important, is the quantity control the quantity of money that is available, which is the money supply. And this monetary policy is made by the Federal Open Market Committee, which the abbreviation is FOMC, and each 6 weeks to consider changes in monetary policy. So they gather each 6 weeks and they say, okay, we need to change our monetary policy in order to change at the end of the day the money supply, and then naturally we're going to affect the inflation. So we're going to talk a little bit about the Federal Open Market Committee, which is in charge of the monetary policy in the United States. So 7 members of Board of Governors, 5 of the 12 regional bank presidents, they attend by 12 but just votes 5, and they change every single meeting. Just the one that it starts or it belongs to the board or to the committee is the New York, that always get a vote because this is the most important city in terms of the economy. And actually all the purchases and sales are conducted by the New York trading desk. We're going to discuss about which purchases and which sales they perform. So the FOMC, they has the power to increase or decrease the amount of money in the economy. So if you can think, the easiest thing you can think is like this: they go around the country by helicopter and they drop around money, and when they need to take out money, they suck in from people's wallets. This is what they do, but we're going to discuss about the mechanisms. So the instrument to make that, not a helicopter nor a vacuum cleaner, actually the instrument is the open market operation. So basically what they do, they purchase and they sell government bonds. What is government bonds? Government bonds, it's like basically debt that is issued by the US government to get money from people because they want to make some investment in infrastructure, or they need to complete the payments that they are not completed or they are not fulfilled by the taxes. So they need money from the market to use or to complete these payments. This is actually considered the most secure asset in the world because there is no possibility between quotation mark of default. So for this reason, maybe the interest rate is kind of low because of the risk associated with this particular asset. So how we can increase money supply? So the Fed prints money and basically they buy US government bonds. When they automatically they buy throughout the FOMC, they buy government bonds, then the dollars, they are in the hand of the public. So then it increases money supply. In order to decrease money supply is the opposite. So the Fed, they have government bonds, so they sell. When they sell, they take money from people, from the public, in the nation's bond market. So then the money supply decreases. So remember one of the 10 principles of economics. Prices go up when government print too much money. So this quotation that everybody says the poverty issues could be solved if the government print money. So if the Fed go and prints money, well, actually the thing we're going just to create increases in prices. Then for this reason, the situation here between inflation and unemployment. So it's a short run, like disruption, or maybe like a situation to choose which should be better, inflation or unemployment. So then this is the problem with the money in the economy. So now we're going to discuss the role of the banks, the commercial banks that you know, and the money supply. Because even if the central bank is the authority that controls the quantity of money in the economy, the commercial banks, they can create money, and even the households, they can change the situation of money supply. So for this reason, their behavior, they are as important as the Fed in the situation of monetary policy or money supply. So we know that the bills and coins, they make part of money, but the deposits also, because they are held in banks, and they can create money as well, because this money that you deposit in a bank, it doesn't remain in that place at all completely. Actually, it can go to other hands, so then you will see that this situation can be repeated over and over, and then it's another way to create money in the economy, because you put money in your bank, and this money is like the part of that money can be lent, and then this person can put this part of that money in another account, and this bank makes exactly the same, so the situation can repeat over and over. So then it's kind of difficult to control money supply. So we're going to start with the simplest model in the money supply is what we call the simple case of 100%. Basically, is what we call a reserve banking. So this bank just receives your deposits, but this is not able to reproduce money. Is not able to take this part of, or part of your money to make loans. So the situation just like banks at all. So the total money supply should be the currency. With imagine that situation is 100. Now a First National Bank is created, but this is just a depository institution. Then it just receives, but it does not make loans. So the deposit that this bank have received have not loaned out of reserves. So this is the balance sheet of this First National Bank. The balance sheet is like a photo, or as the photo of a situation of a specific company in a particular specific time. So when we have the magic equation in the accountant, which is just assets minus liabilities, is exactly equal to the owner's capital, or owner's capital plus liabilities is exactly equal to assets. In this case, the First National Bank, the assets are the reserves that they have in the banks, they are 100, and the liabilities, the deposit of 100, because when the people they ask for money, they will ask for the liabilities of this First National Bank, and the assets will decrease at the same time. So in this situation, we have assets exactly equal to liabilities, no owner's capital. Then, before the Bank of Money Supply was 100 held in currency. After the bank existence, the money supply is held in deposit bank, which is exactly equal to 100. Each deposit reduces currency and raises demand deposit in the same amount. If bank holds all deposits in reserve, it doesn't change money supply. The money supply is exactly the same. Now imagine the situation of fractional reserve banking. This is the common system that is used now, where the banks they can lend this money out of part of the reserves, at least in part. So this is the situation that they can create money. So if banks start to lend money, they can use part of the deposit to make loans. Then, why we can make loans? Because basically, family they buy houses, and we know that we don't have the money to pay all house like in one just payment, one unique payment. So then we need to ask for a loan for a mortgage, and then the firms they need to build new plants. They don't have the cash to make it, so they need to ask for money, or in United States so famous that students they need to pay for college, so they ask for money. Naturally, they are completely right that they need to pay interest to borrow some money for a while. The First National Bank needs to make sure to have some money in demand deposits when people want to make some withdrawals. So this is what the fractional reserve backing is the measure. So the fraction of bank holds in the reserve ratio influenced by government regulation and bank policy. The reserve ratio is not more than basically the reserves over the deposits. The higher ratio you have is like you have all your deposits, you have all in reserves. The lower is like you have less money available to respond to possible withdrawals of your clients. So the Fed start to regulate that system with a minimum requirement that banks they should hold in the bank. This is what we call the reserve requirement. So then, this is the situation of the First National Banks. So we're going to pay attention of that afterwards. First, we need to have a look here. So the banks usually hold more money in their deposits than this excess of reserves. So Fed says, okay, it's 20% the minimum requirement, but usually the banks they have like 30% or 40%, whatever, something higher. So they have usually they face excess reserves. So imagine the situation that the First National Bank they have a reserve of 10%. The rest is to be loaned. So then remember that we have in demand deposits we have 100, but as reserve we're going just to keep the 10% of this 100, but we're going to make some loans of 90%. Their assets obviously they are less liquid than the reserves because we had like it was like cash, but loans this is money that we need to recover. So this is like something like account receivables. And then liabilities, you have this deposit that we need to respond for naturally the money of the people that we ask. You can think maybe about the interest now. We're going just to not take into account to make or keep the things easy. So liabilities remain the same. Banks under this system creates money. It creates 90 that it wasn't before. So this is a way how banks creates money. But remember, we're talking about more money but not more wealth, because the wealth is exactly the same. So then you are thinking now that maybe the quantity of money is like infinite, because if this process is making over and over, we're going to create an infinite quantity of money and infinite inflation. Well, actually we're going to have like a maximum, like a threshold. So then imagine that that has this $90, this pays something, and this person put that money in the Second National Bank. So then actually this 90, this go to this Second National Bank. They have exactly the same limit that they can make loans, which is 10%. So then the reserves remain 9, but the loans 81, and the deposits, the liabilities 90. And then the loans, they're going to be taken from another guy, and they can make exactly the same process. So we have 10% of ratio, which is $9 in assets and 81 in loans. So imagine that these $81 go to a Third National Bank. So the balance sheet of the Third National Bank should be something like that. The 10% of $81 and the 90% in loans. And then we have this one, the deposits. So then the process goes on and goes on. Basically, this should be something like that. The original deposit was 100. Then, because of the reserve ratio, the First National Lending can use these $90 to make loans. Then it should be 0.9 times 100. Then the Second National Lending has the possibility to make more loans for 10%, which should be 0.9 times $90. And then this process continues. When we make that, we are going to have at the end of the day that the money supply should be 1000. Why? Because this is a serious arithmetic series. This is not the scope of this course, but you need to take this as granted that we are going to have $1000, and then we actually doesn't create amount infinite money. This is limited, and the monetary policy multiplier in this case is 10. So you are figuring out that this is like 1 over the reserve rate. This is the opposite, right? So then this is the quantity of the multiplier. So naturally, if we have here the multiplier reciprocal of reserve fraction, so then we have this should be 10. So for example, when we have the higher reserve ratio, what we're going to have here, the lower the multiplier, right? So then we have this situation. Let's think, or let's quote about some famous crisis. But we have financial crisis of 2008 and 9, and I guess that everybody in this video in 2020, they lived this crisis, and maybe it was kind of hard to understand what happened. Well, basically, we know that the real banking a little more complicated than this situation that we represented before, because the banks, they not only get money by deposits, they issue equity and debt. So basically, equity is more associated with bonds, and debt with stocks. So when they issue this money, then an investor pay for that, and then this is expected to have a return. In the bonds, you're expecting to have some interest rate return, and in the stocks, you are waiting for some dividends. The point is like the resources that a bank obtains from issuing equity is what we call the bank capital, and the bank buys financial securities, which is basically stocks and bonds, right? So, for example, this is a more realistic national bank. We have the reserves, which we already know what it means. It's the money that you keep in your bank in terms of respond to possible withdrawals. You have some loans, which is 700 in this particular case. So you have some loans, and you like account receivables, and actually some securities, which should be stocks and bonds from other institutions. The other part, we have the deposits, which is 800. So this is money that you need to ask if someone asks for money because they are a card holders. So you need to have this 800 as a liability, and that this debt should be 150. Why? Because this debt should be exactly basically debt that you issue, which is 150, and then this should be 50 actually was the one that you issue. Okay, this is like you owner equity, so you issue equity or equity in that case, and then you receive this money, and there's the difference, the subtraction between these two is the money that we have now in securities. So then owner's equity is basically capital, and then we know that the accounting equation is assets minus liabilities equal to owner's equity, and the leverage is the borrowed money for investing purposes. This is the definition of leverage. So we have the leverage ratio in this case, which is assets over capital, which is 1000 over 50, then it should be 20. The meaning of this 20 is like for every dollar owner has contributed, the bank has $20 of assets. So then, imagine an increase of $5% in assets value. It means that an increased capital of 50. Then it is an increase of 100% in capital. So this is basically a lever. It's what we call a lever. So then, if it's the opposite, then the bank decreases and the company can declare itself as insolvent. It is what had happened. It was a decrease in assets. It was excess of leverage for banks. So a lot of banks, they can declare itself or themselves as insolvent. So then the bank regulator informed the banks the capital requirement is to ensure that banks will be able to pay depositors. So then naturally it depends in the kind of capital of assets a bank holds. If these banks, if they hold risky assets, the capital requirement should be higher. It was basically economic turmoil because it resulted when there is too little capital because the banks, they incurred in some sizable losses on some of their assets. It's basically what we call credit crunch. So then the government and Fed, they put many billions of dollars of public funds into the banking system to increase bank capital. See, it was the way to solve this crisis. So this is like really small summary of the situation of the financial crisis in 2008 and 9. So what are the tools of monetary controls given by the Fed? So we know that they are responsible to supply money in the economy. So basically the banks create money in the system of fractional reserve banking. But the Fed's control is control that indirectly. So basically we have two groups of policies. The first is to influence the quantity of reserves and those that influence the reserve ratio. Then the multiplier. So then, how the Fed influences the quantity of reserves. So basically they can buy or sell bonds in open market operation as we explained before, then or maybe making some loans to banks, or maybe they can make both. Remember that the open market operation, this is basically to increase the New York Fed buys bonds that then increase the number of dollars in the economy, and some are held in currency and some are in deposit. The more we have in deposit of that money, this is more effect that we are going to have as a multiplier. We know that each new dollar as currency increases money supply by $1, but each dollar in banks increases more than a dollar because of the multiplier. So then to decrease the quantity of money, it makes the opposite. The Fed sell bonds into the market. Actually, this is the policy most used, the open market operation. Other one, which is not so common, is the Fed lending to banks. So basically the Fed provides money to banks to provide reserves. Naturally, the banks need to repay that with more money, I'll increase, which is what we call the discount rate. The higher discount rate discourages banks to borrow. And then we have the other part, which is the reserve requirements. If it increases, less money can be lent. And we have like this important fact here that should be like paying interest on reserves. Before 2008, it wasn't possible. The banks that they have reserves, it doesn't generate any interest, but now yes. So the higher you pay in those interests, the lower incentive you have for the banks to make loans. So then this is the relationship. What are the problems in controlling the money supply? Unfortunately, the Fed cannot control the quantity of money that they will put as deposits, because if a lot of people they make withdrawals, money supply will fall without any action of Fed, for example, because more withdrawals, it means more currency, it means less effect of the money multiplier, so then people withdrawals may affect the monetary policy. But another thing is like bank has the possibility to lend what they want, because it is true that we have a minimum requirement. It isn't that we have a roof. So maybe we can think at 90% reserve ratio. So we are going just to lend 10% of my reserves. So in that case, the banks they have the possibility to affect in a different way the monetary policy if they fix different reserve ratio or reserve requirement. Okay, as a conclusion, the general convention of money. So money as a general convention is the original father to make all this possible. If no one trusts in money, is what is happening now maybe in Venezuela, they look for another asset that they really trust, in this case dollars, for example. So it's what we call the dollarization of an economy. In that case, if this is fulfilled, that people trust in money, then transaction can make over and over and over. And then what the Fed is the in charge, the one institute that in charge the control of the monetary of money supply. Why it is important? Because more money, more prices, and more prices trade with unemployment. So then we are going to explore a little bit now that we understand well the situation of federal central bank with the Fed and the commercial banks, the possibility to create money, how affect the situation of households and the banks per se, and then understand a little bit better the movement of money supply and how it affects economy. Thank you again for watching my videos. Please subscribe and see you next video. Bye bye.